Hi everyone, good to all. In this presentation, we will be discussing about the basics of accounting. Let's go through the content. First one, definition of accounting, procedures of accounting, evolution of accounting, objectives, functions. What do you mean by bookkeeping and how it is different from accounting? Subfields of accounting, uses of accounting, relationship of accounting with other disciplines, and ends with the limitation of accounting. Let's first discuss the definition of accounting. Here, American Institute of Certified Public Accountants explain or define accounting as accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part of a financial character and interpreting the results thereof. Okay, let's break this definition into parts and can explain it one by one. First of all, accounting is referred as an art. Why it is referred as an art? Art means something with practical application of knowledge for the attainment of certain goals. For example, dance, music, drawing, these are arts because all these things involve certain specialized knowledge. We need certain knowledge about that. But the person who is performing it, the end result will be different for each one because there involves certain skill. The person performing it, the skill of the person who is performing it will be different. So the presentation will also be, performance will be also be different. That is referred as an art. Likewise, accounting is also an art because even though it is based on the accounting concepts and conventions, the accountant have certain skill or the judgment of that person is very important in accounting process. So, accounting is referred as an art and is of recording, classifying, and summarizing. These are the procedures of accounting. Each of them will be discussed in the later part of this presentation. Let's move on. In a significant manner. In a significant manner means every organization, the accounting has certain globally accepted principles and conventions. Every accountant should follow such convention. That's why it is referred as in a significant manner. We have to do it in that particular manner. And in terms of money, transactions, and events which are in part of a financial character. Here, in terms of money means only monetary items will be included in accounting. Let's consider an example. For example, if an organization, there is a manager who is a very intelligent manager. An intelligent manager is an asset for an organization, but we cannot measure his intelligence. So we cannot include him as an asset of the organization in accounting. That's if we consider another example, if a person who is not loyal to the organization, that person may create problems for the organization who might be creating a burden for the organization, might be a burden for the organization. But we cannot represent him in an accounting terms or in monetary terms, or we cannot measure his value. So accounting only measures monetary items. So such items cannot be included. That's one of the limitations of accounting. Okay, that is referred here as in terms of money, transactions, and events which are in part of financial character. Means in financial character means in India we follow currency, rupee currency, or in another country it will be following a different currency, in a foreign currency likewise. And interpreting the results thereof. Interpreting the result means the data which was created using accounting is later interpreted and is communicated with the end users. That is referred in the last part of the definition. Okay, let's move on to the procedures of accounting. The accounting process can be broadly classified in two parts. First one is generating the financial information and second one is using the financial information. The first stage is generating the financial information. The end result of an accounting process is their financial statement, like balance sheet, profit and loss, and cash flow statement. It will be different for different entities, and the basic one is balance sheet and profit and loss. So the first part of a stage of accounting is generating these financial information. It involves 3 steps. That is, first one is recording, second one is classifying, and third, summarizing. Later, after generating the information, it is used by the end users. That's the second part. That is using the financial information, which involves analyzing, interpreting, and communicating. These are the procedures of accounting. Let's discuss each one of them. First one, recording. The process of accounting starts by first identifying the events and transactions which are of financial character and then be recorded in the books of accounts. That we have already said that only monetary items will be included in accounting. Therefore, we have to identify the monetary transactions first. Then after identifying the transaction, we have to record it in the book called journal. That is the first book of accounts. The process of recording a transaction, the initial recording of a transaction is called journalizing, and the book is called journal. The recording of journal is done from a source document. When a sales happen, there will be a receipt. When a purchase happen, there will be a bill. There are certain source documents from which the amount is drawn by the accountant. And later it is included in the book called journal. That's the first process of accounting. Second process is classifying. What do you mean by classifying? It means grouping of the transactions. In an organization, there will be thousands of transactions. In case of a multinational company, they might be having millions of transactions in a year. So it is hard for the owner or an external party to find the financial result or the performance of an entity by referring through the each and every transactions of the organization. So the second step in accounting is classifying, which means transactions of similar nature are grouped together, and these grouped items are recorded in a book called ledger, which means ledger is a set of accounts. Accounts means each transactions of similar nature are recorded in that account, in a sheet called account. And this set of all accounts are grouped together to form the ledger. That's the second stage of classifying, accounting, that is classifying. And the third stage is summarizing. That is the preparation of financial statement. After the ledger is made, the transactions of a year, for example, the total sales of an organization is find out from the sales account, or the total rent of an organization can be found from the rent account. Likewise, the similar transactions, grouping of transactions helps in summarizing or helps in totaling of the whole sales of an organization. And based on that total, the financial statements are prepared. And the financial statements are finally summarized together to present the balance sheet and profit and loss. Balance sheet represents the financial position of the organization, whether it is liquid or whether does it have proper solvency. This can be found out from the balance sheet. And the second is profit and loss account. It represents the profit of the organization, whether the firm is having profit or whether it is in loss. This can be found out from the profit and loss account. Likewise, the third step in summarizing is the preparation of financial statements. There ends the generation of information. Then the next step is analysis. There we are using the information which we have generated. The financial statements we have already prepared. Using the each item of the financial statement, there might be having assets, liabilities, and different kinds of things. And based on these items, the interrelationship between the various items of the financial statements are find out are brought out from the analysis process. That is the fourth stage. Here the various relationship between items of profit and loss and balance sheet is made. For example, sales turnover means inventory turnover ratio, which represents the number of times the inventory is purchased and sold, and a full swap of inventory happens. How many times it happens, it can be referred from that particular ratio. Likewise, there are many other ratios. The ratios are find out from the analysis process. This happens in analysis. The next is interpreting. Based on the relationship, we can make certain interpretations. If an organization is having high inventory turnover, which means its sales happens very fast, so it will be generating or realizing cash in a very fast manner. That's the next step, that is interpreting the results using the ratios which were or relationship established during the analysis process. And after that, we have to communicate the information with the end users. That is the final product of accounting, final stage of accounting, that is communicating the information. These are the 6 stages of accounting. Now let's discuss the evolution of accounting. Accounting dates back to 4000 BC. Not in the modern form, but in the initial form where people used to record the transactions, where date back to 4000 BC, because since then the accounting has started, the recording of transactions have started. Now the modern accounting or bookkeeping was developed by Luca Pacioli. He is an Italian mathematician, and the terms debit and credit, these are very important terms in an accounts, and the first person to use that term is Luca Pacioli. The double entry system of accounting was developed by him. Okay, then we can refer the different stages of accounting. The first stage was the stewardship function, where landlords used to collect rent from their paid tenants by using an intermediary. The intermediary is responsible for recording the transaction. That was the first stage of accounting. That's the oldest form of accounting. The second stage is the financial accounting that we are using currently. The financial accounting, which refers to the recording of transaction and the full process of accounting which we follow in an organization. That's the second stage. The third stage is management accounting. Management accounting means organization, especially in case of companies, the owners are different from its management. The management is responsible for carrying out the activities of the organization, and the shareholders are the owners of the company. So since the owners are not responsible in carrying out the day-to-day activities, they have to make sure that the management is doing it in the right way. So here comes the need for management accounting. Management accounting, here the management uses the data generated in financial accounting for decision making. That's why it's called management account. That's the third stage, that is an extended version of financial accounting. Then comes the fourth stage, that is final stage, that is social responsibility accounting. Now an entity or every organization nowadays are considered as an social entity. They are responsible for whatever it generates for the society, whether it's bad or good. If it creates some cost for the society, whether it creates any benefit for the society, both should be measured. That measurement of social responsibility is called social responsibility accounting. Final objectives of accounting. What is the end result of accounting? That is referred as objectives of accounting. We know that the accounting process ends with the preparation of financial statement. Financial statement consists of balance sheet, profit and loss, and they will be having books of accounts and many other reports. Each of this will be providing certain benefit to the owners. If we refer the objectives, first one, recording of transaction is the first objective. We can a systematic recording of all transactions of the organization. That's the first objective. And the profit and loss of account helps in ascertaining the financial result. That's the second objective. The balance sheet helps in ascertaining the financial position of the entity. So it's third objective. And fourth one is financial report, means the final output that we communicate with the end users. That the last stage, that is communicating the information to the various users. That's the fourth objective of accounting. And the fifth one is the solvency position. Solvency means ability of an organization to meet its current liabilities is called solvency. Or every liability, the ability of the organization to meet its liabilities is called solvency. These are the objectives of accounting. It includes the recording of systematic recording of transaction, helps in finding the financial position, financial results, and rational decision making helpful on, and to know the solvency position. Next one is functions of accounting. What are the functions of accounting? It's the measurement of past performance. We see accounting as a historical activity because historical costs are only considered in accounting. So it's a measurement of past performance and an activity which has already happened. We record that transaction only transactions which have already done. We will not record the future transactions. That's why it's referred as measurement of past performance. Based on the past performance, we can forecast the future. That's the second function. It helps in forecasting the future. And based on the forecast, we can make decisions like how much to be invested or how much fund is required for the next year. So we can make planning for that. That's the third stage, that is decision making. And after the forecasting, we can make comparison and evaluation of financial result. We can compare it with the estimation, that is, if an organization estimates the sales for the next year, and the actual result and the estimated sales can be compared, and we can identify the deficiencies in the organizational system, which we can take measures to overcome it. That's the last and next stage, that is control. And final, it comes the government regulation and taxation. The government gets a result or gets data from the accounting process. So government regulation and taxation is, for government, it's very important to have accounting. If an organization does not maintain proper record, it would affect the revenue of the government. So it is very important to maintain a proper record of books. Here comes the next, that is bookkeeping. Bookkeeping is the oldest form of accounting. Before the financial statements were evolved, we used to follow bookkeeping. Bookkeeping means recording of the financial data. That is referred to as bookkeeping. Bookkeeping is a part of accounting process, but it is not accounting. It is different from accounting. Accounting is an advanced form of bookkeeping. Bookkeeping just records only transactions, records the financial transactions of an organization under each heads of income. The objectives of bookkeeping is to recording of the transaction and financial effect of the business. Distinction between bookkeeping and accounting. First one is recording. Second involves summarizing. It's a base for accounting, and the other one is language of business. It's do not form part of this process. Financial statements do not form part of this process because bookkeeping does not create financial statements, but accounting results in financial statement. Managerial decisions cannot be taken because managerial decisions are made out of financial statements. Since bookkeeping does not create financial statements, it cannot make managerial decisions. But on the other hand, accounting has decisions, can take decisions based on the records. There is no subfield of bookkeeping, but accounting has many subfields like financial accounting, management accounting, etc. Financial position of a business cannot be ascertained through bookkeeping, financial position of the business is ascertained on the basis of accounting records. These are the distinction between bookkeeping and accounting. Next is subfields of accounting. The advanced versions of accounting, we can refer it as advanced versions of accounting. For example, financial accounting is the basic accounting form which we use that helps in determining the financial position and net results of the organization. That's called financial accounting. Management accounting refers to the management uses this data which was generated during the financial accounting to make decisions. That's called management accounting. Here the information is processed or reports are made in order to help the managers to take decision. They are further processed in order to help the management to take decisions. That is called management accounting. Cost accounting is a part of management accounting. Next one is cost accounting. Cost accounting is the process of accounting for cost which begins with the recording of income and expenditure and the basis on which they are recorded and ends with the preparation of periodical statements and reports for ascertaining and controlling of cost. Cost accounting is based on the recording of cost. The cost of every transaction is recorded and the cost of each unit is ascertained. Here the profit is not considered, only cost of the organization is considered. Then next, social responsibility accounting, that we have already referred. That is, we consider the social cost and benefit generated by the organization, and it's called social responsibility accounting. Human resource accounting, here the name itself gives, means human resource means human beings, the ability of the human beings, we are not able to measure it, even though in human resource accounting we will be measuring, identify and quantify the report of investment made in human resources, and they are presented for accounted under conventional accounting practice. Under conventional accounting practice, we will measure the investment in human resource. That is called human resource accounting. Next is the users of accounting information. Who are the users of accounting information? There are different stakeholders for an organization, and everyone will need information. It is generated from the accounting process. And the users are, first one is investor. In case of a company, the owner and the management is different. The person who is managing the business and the owner of the organization are different. Likewise, investor is a person who invests in the business. They are not concerned about the financial position. They are concerned about the financial position of the organization, because only good company will generate good revenue, or if a company which has a few better prospects in the future will generate a better share price in the future. So it's very important for the investor to look over the financial report of the company. Next is employees. The growth of an employee depends upon the stability of the organization. So employees are also interested. Leaders. Lenders means the person who lends money for the organization. If an organization who is not able to meet its liabilities, the lenders may not be able to will not be interested in giving the credit. So the credit worthiness of the person who is seeking loan is very important. Therefore, the lenders are also interested in knowing the financial position of the entities. Next one is suppliers and creditors. Suppliers means the person who provides goods for an organization. In case of a manufacturing organization or in a trading organization, the goods are supplied by the supplier. Most of the organization suppliers provide credit for the customers because it helps them to increase their sales. Therefore, if they provide credit, if the organization is not able to meet its credit in the future, it may affect the supplier. So it's important to consider the financial position of the customers. That's why it is referred as user. Next is customer. Customer is the person who purchases the goods from the organization. the functioning is more or less dependent on the supply of goods. Stability and profitability of the enterprise, because their functioning is more or less dependent on the supply of goods. If a particular customer solely depends on a particular company, if the company stops functioning, it would affect the customer also, because he will not be getting proper supply of goods. It will affect him. So it's important for the customer to know the financial position or its stability of the organization. Next is government and their agencies. Government generate revenue from entities by collecting taxes. So the accounting process is very important in identifying the proper revenue of the organization and to apply proper tax. Next is public. Public is interested in knowing, because if in a society, if there is an organization, there are many other benefits associated with it, because in an entity it provides lots of employment opportunities for the people. So it's very important for the public to know the functioning of an enterprise. Next is management. Management is the person who is responsible for managing the organization. The better performance is their aim, so they have to consider the financial results. Relationship of accounting with other disciplines. First one, accounting and economics. We know that resources are scarce, but the ones are unlimited. So we have to efficiently utilize the resources. Resources involves the resources of a country, or it consists of the resources of an entity. All these requires a proper rational decision in using that resources. So that's the need for economics. Economics is a science of rational decision making about the use of scarce resource, and the decision can only be made out of the financial data that is provided by accounting. We generate information from accounting, and this information is used to ensure how to utilize the resources. That's the relation between economics and accounting. In macro level, accounting provides a database for the economic decisions that have been developed. Most of the economic decision models have been developed based on accounting data. And micro level data arranged by the accounting is summed up to get the micro level database. That's a relation between accounting and economics. In accounting, all values are important. Each and every values of an entity or a transaction or sum of accounts are very important for an organization. Each item of a balance sheet is also very important. But in order to take decision, we have to establish the relationship of various items of the balance sheet and a profit and loss. In order to generate that relationship, we use statistics. Statistics is concerned with the typical value, behavior or trend over a period of time. It helps in creating a ratio or a trend or percentage of profit likewise. So these can be generated using statistics. So statistics is used in interpretation of the accounting results. For example, net profit ratio, gross profit ratio, inventory turnover ratio, these kinds of ratios are generated from accounting data, and these are from statistical models or statistical ratios. That's the relation between accounting and statistics. It helps in longer view of the entity over the year, and total cost to price can be determined. Multiple discriminate analysis is possible using the multiple discriminate analysis is a analysis which is conducted to identify the symptoms of sickness of a business firm. So it's also an application of statistics. That are the various applications of statistics. Next one is mathematics. We know that the basic mathematical functions like sum, divide, division, everything happens which are the basic for accounting. In accounting we use addition, and for netting of accounts we use subtraction. So the mathematics is very base for accounting. Even we use graphs and charts for communicating the accounting information, and even the double entry bookkeeping is in the form of an algebraic form, can be represented in an algebraic form, that is asset is equal to equity plus liabilities. It's an algebraic form. So these are the various applications of mathematics. Let's refer it. Calculation of interest and annuity of a firm, or depreciation of a firm, or accounting ratios, all these are made from mathematics. Next is accounting and law. Every entity of a country is subject to various laws of legislations of the country. For example, Contract Act, Sale of Goods Act, Negotiable Instruments. All these legislations are is to be considered while conducting an audit of an environment of an entity. For example, if a company, most of the companies are established under the Companies Act, so the regulations of companies will be as per the Companies Act, and rules are made on the basis of that. And every country has a set of economic, fiscal and labor laws, and every company should follow the law. So accounting is very much related with the law. Even the format of presentation of the financial information is also specified by certain legislations. For example, Companies Act to provide the format of balance sheet in its schedule. This is how accounting and law relates. Next is accounting and management. We know that management is not just a particular team of persons or the managers. Management refers to the activities or functions performed by them. The process of planning, processing, staffing, directing and all. This is the process of management. It's very much related with accounting, because every stages of these management functions are performed using the accounting data, and it provides a basic document for the management. That's why accounting and management are related. Okay, the last part of this presentation is limitations of accounting. What are the limitations of accounting? Few of them were already discussed. First one is, we have already seen that accounting only presents in monetary terms, so it does not consider non-monetary items. It is one of the limitations of accounting. For example, loyalty and skill of a personnel cannot be included in the accounting data. That's the one limitation of the accounting process. Second one, users are interested in knowing the future, but information are based on historical cost. Accounting is based on historical cost. We can estimate the future, but we cannot present the future. So it creates there is always an uncertainty for the future. That's one of the limitations of accounting, and it ignores inflation. Every society have some in accounting, it ignores inflation. Accounting is based on historical cost. It does not consider the inflation, so the information is also affected by that limitation. Accounting principles may conflict each other, because there are different principles, and certain principles may conflict in their presentation, and it is based on the judgment of the accountant. Certain accounting estimates are based on the judgment of accountant. So if the accountant wish to make judgment which are favorable for the entity, it would create a limitation of accounting. Then accounting policies for the treatment of same item adds to probability of manipulation. There are different accounting policies for the same item. For example, depreciation is calculated on different methods like weighted average method, straight line method. So the value generated using the different methods are also different. So there are chances of manipulation. These are the limitations of accounting. Thank you.